Assalamu alaikum, have a good day. Today we are going to start a financial statement analysis for taxation. This is our 301 part A. Management is a vital part. So here each and every item, each and every component need for decision making for the management. So that type of analysis we can set sometimes common size statement. That common size statement also is our vertical analysis also. And some trend analysis. It shows the trend where the company is going. That means ratio analysis, another vital part. So here horizontal analysis we can calculate this way. Horizontal analysis, the absolute figure comes amount in compare year minus amount in base year. Look here current asset amount is compare year. Compare is 2030 and base year 2012. So here 10,20,000 minus 9,42,000. This is the figure amount of comparison year minus amount in base year. And if we go for percentage, this way we can make percentage amount in compare year minus amount is base year divided by amount is base year multiply by 100. That figure comes 7.9%. Same here. And advantage, it has some advantage, some disadvantages. And vertical analysis we can calculate this way. Vertical analysis for income statement item divided by total as sale multiply by 100. And based on that is for the balance sheet, it's balance sheet item divided by total asset or liability multiply by 100. So this way calculate the percentage. And key financial statement, how they analyze is here. We know that our that is a balance sheet. We can prepare balance sheet in different way. As per IFRS liquidity based balance sheet formula, here most liquid item would be the upper side. For example, asset side, cash equivalent, and that means least liquidity is the lower side. That is goodwill, other current asset, etc. So this is the segregation. This is the presentation style of asset. Same way liability. Most liquidity would be the upper side. That means account payable, notes payable, tax payable, accrued liability, etc. And harder one would be lower side. Owner's security, same way. So here asset means as per the accounting policy, we know accounting equation, it's mean our total liability plus stockholder equity. And current asset, what is current asset? If we say current asset, that means we have to, that means current asset held by the firm refers to the cash equivalent. We know is all inventories, all receivable, etc. is a part of the current asset. Long-term asset is the hard one. And total asset, current asset plus our long-term asset. So here current liability same way, and that balance sheet also we can prepare in classified balance sheet item. We can classify for example based on current asset, non-current asset, also current liability, non-current liability, owner's equity. This way we can be classified. And if we see the balance sheet analysis of what is the relationship, look here, financial statement relationship here. If we see here the balance sheet is the income statement, a statement of cash flow, a statement of stakeholder equity. So here current asset from the balance sheet is go to the statement of cash flow is the ending cash. It must be equivalent. Then equity of the balance sheet is the part of the ending equity. That means a statement of stakeholder equity. And income statement of net income is also the net income include the statement of that means of shareholder equity. Here beginning item plus net income minus dividend, and then closing balance. That closing balance must be with the that means equity. And this way we can that means relation, we can make the relation. Also there are some accounting term also we know we have debit, credit. So if we got time then we'll discuss the fundamental thing, and you all are know it but who are not from the accounting side, that the new for him or her. So we will discuss one class later on. We know the debt equity ratio, debt divided by equity ratio, and different types of ratio we will see here. So income statement is come, how income statement comes. This is the logical item. So here sale revenue, from the revenue, if we minus cost of goods sold, then we'll get gross profit. And from the gross profit, if we minus sale, general administrative cost, and also research and development cost, then we'll get earnings before interest, tax, depreciation, or amortization. And from that amount, if we minus or deduct depreciation or amortization, then we will get earning before interest and tax, EBIT. And from that EBIT, if we minus interest, what that is bank interest, etc., then we will get earning before tax, EBT. And from that earning before tax, if we minus tax, then we will get net income or earning after tax. Also, we can say it earning after tax, EAT. So this is the logical calculation. And if we see income statement analysis, here we see gross profit, operating income, net income, and that types of ratio we're using. So, and cash flow, we know that there is three activities: operating, investing, and financing. And cash activity, operating, financing activities. And another thing, free cash flow. We are calculating cash flow as per International Accounting Standard 7. What is the free cash flow? So free cash flow is means that if we minus the commitment from the cash flow, that would be the free cash flow. That free cash flow, no commitment, no obligation within that cash. So is the free cash flow. So business statement change equity. This is the, and comparison we can compare. Now, why financial statement important to the tax authorities? The financial statement of a business provide a formal record of its financial activities. As a business owner, our financial statement offer valuable information about our company's overall financial position. And financial statement are important to the tax authority to ensure the accuracy of tax and additional duties declared and paid by the company. That's why financial statement is very much important for the tax authority. So here is the tax provision side. Taxable income, expense, deferred tax, we will discuss also. Difference between accounting. If you see here, taxable income. Tax authority will use the statement of determine the company's tax liability. So what is tax income? Taxable income is the basis of the company's income tax payable or recoverable. It is calculated on the base on the company's tax rate and appear to the balance sheet. So tax expense, that means it's recorded in the income statement as the aggregations of the company's income tax, how much tax have to pay. And deferred tax will take one class of within that item. Deferred tax asset arise when a company's taxable income is greater than the accounting profit. And deferred tax liability, valuation, tax carrying, etc. So here, difference between accounting profit and taxable income. We know our accounting profit and taxable income, but taxable profit are not the same. Why these differences? So revenue and expense, if we see one by one, revenue and expense may be recognized as one reporting period for tax purpose and in the another period for accounting purpose. Basically, what we are saying, our basic difference would be in depreciation, provident fund, gratuity, and revenue recognition, etc. So what is the difference between depreciation? Our third schedule specific describe the rate of depreciation. What item, what would be the rate? But as per the accounting standard, it's also the difference. For example, one of our furniture or one of our machine, we for the life for the 10 years. So as per the accounting policy, 10% would be the depreciation, because after 10 years, the no more the machine for the use. But if we see our third schedule, if there is 20% or 5%, it may be happen. So that rate should be different. That rate be change accounting profit and taxable. But tax authority, they firstly when go for the assessment, firstly that means disallow it for the separate calculation. So depreciation they firstly deduct from the our calculation. So when the tax authority will calculate in different way. Also, we are using an straight line method. For example, 10% depreciation, full life, 10 years, 10%, 10%, 10%. But tax authority calculating in different way. What is the different way? They are calculating diminishing balancing method. For example, this year, if we use 10%, for example, is 100 taka using 10%, so remaining 90 taka. So next year in accounting side, it also be 10 taka. But tax authority that 10% use on that 90 taka. So that year tax would depreciation would be 9 taka. But accounting it's the 10 taka. So here is some difference. And this difference is temporary difference, and this temporary difference will be solved in whole life of the item, or a specific item. In the closing year, all would be the balance. There would not be gap, there would be no temporary difference in the closing year. So that temporary difference create a tax liability or asset. That is the deferred tax. So we will discuss in deferred tax as per International Accounting Standard 12, and we will take some math also. So that's why here is the difference between profit, accounting profit and tax profit. And a specific revenue and expense item may be either not recognized in accounting purpose, but recognized for the tax purpose. The tax base and carrying amount of asset and liability may differ. The deductibles, for example, this base in that what we discussed, 9 taka and 10 taka. The deductibility of gains, loss, etc., tax loss, etc. So this is the different types of difference between accounting profit and taxable profit. And another item, we have the ratio analysis. And ratio analysis is also a vital part of financial statement analysis. So here we can calculate, we can analyze two ways. One is traditional, another functional. This functional means based on the function, based on the operation. So within the functional, we can see liquidity ratio. So there are three types of liquidity ratio. We have current ratio, liquidity ratio, acid test ratio, etc. And profitability ratio, there are different types of profitability: gross profit ratio, net profit ratio, expense ratio, operating ratio, return on capital employed ratio, return on shareholders fund, etc. And same way leverage ratio, priority ratio, debt equity ratio, gearing ratio, fixed asset ratio, etc. And activity ratio, that means debtors turnover, creditors turnover, asset turnover, fixed asset turnover, etc. That type of ratio we are using. So sometimes we are using solvency ratio. Is the solvency ratio is measure of the ability of a company to pay its long-term debt. and the interest on the debt. That's why that solvency ratio is required for the stakeholder, for the debtors or creditors or any other person, for understanding the company's solvency for the future sustainability. And solvency ratio is a part of the financial ratio, help business owner determine the change of the company's long-term survival. And solvency ratio we can calculate net income plus depreciation divided by short-term liability plus long-term liability. And debt equity ratio we are calculating total debt divided by owner's equity. And also we calculate debt to asset, total debt minus or divided by total asset. We can calculate coverage of fixed cost. It means that net income before tax divided by the amount fixed charge, and interest coverage operating income divided by interest expense. This so we can calculate. So this is the formula, basic formula of different types of ratio. Working capital we can calculate it, we know it, current asset minus current liability. Current ratio equal to current asset divided by current liability. Quick or acid test is current liability minus inventory minus prepaid. So why this quick? That means current asset is include also inventory, prepaid, etc. So inventory we have to sell it, then we will be able to find the get the money. So that's how it's minus. Quick this within the time, how much, what is the ratio of quick or acid test? At this moment, what is the cash item? This is the quick ratio. And solvency ratio, in an accounts receivable turnover, etc. Profitability ratio, and some are stock market. What we are in investing in capital market, there are that type of ratio very popular in capital market. For example, EPS. You are going for take your decision for buying or selling your share, which you have. So based on the EPS, based on the price earning ratio, based on the dividend yield, etc., is the for the investors decision making, book value per share, or net cash operating cash flow per share, etc. So EPS we know, net interest available for the shareholder divided by average outstanding common share, and book value per share is stockholder equity minus preferred right divided by outstanding common share. Price earning ratio we can calculate market price per share divided by earning per share. Dividend yield we can calculate dividend per share divided by market price per share. So that type of each have some advantages, we can say calculate it quickly, take the decision, and sometimes it has some disadvantages. Different types of problem also have if we make the decision, that means based on the data, sometimes that decision may not be accurate. So that types of limitation also have. And in firm comparability, we can compare one firm with another firm, and sometimes we need it because for merger or acquisition. And what is merger? Merger, one company, for example, company A plus company B is make company C, so it's the merger. So that type, company A and company B, they do not have the entity, do not have the existence. New company arrive, company AB Limited or company C Limited. Acquisition. What is acquisition? Acquisition means company A plus company B equal to company A, and company B vanish. So company B is a small company, is that means छोटो company के बड़ो company गिले फेलते. So company A is the bigger one. So entity, that means existence of company A at this moment, no existence of company B. So is the acquisition. And merger means both company they lose their entity and new company arise. Acquisition means one bigger company they also go another bigger for acquiring another small company, and a small company they vanish within the market, from the market. So this that's that type of, we need the intercompany comparison also. It's have the limitation. So if we see the financial accounting in our side here, what is the total environment? What is the activities within a business environment? Using the business strategy, using the business activity, accounting strategy, accounting environment, and using the accounting system, we find the financial statement, and that financial statement is the 5 part, and summarize the economic what is the financial statements is the summarize the economic consequence of business activities, economic consequence of business activity. So this way we have all data within the financial statement of a business, and it is the financial statement calculation, financial modeling. So this is the few item today we discuss, and now we go for few math. So what discussed today? So today we discuss here a basic decision of financial management and component of financial management and qualitative characteristics of financial data and the cycle of financial statement analysis or process, user of financial statement, and parties and other stakeholders why financial statement they are using, method of analyzing the financial statement, horizontal, vertical, common size, and we have seen the presentation of balance sheet, liquid based balance sheet, and sometimes classified balance sheet, and relationship financial statement and the income statement, and we discuss here why the financial statement important for the tax authority, difference between the accounting and profit and taxable profit, and the ratio analysis, few items, etc. Now go we have few math here. From that math we can calculate it's also a part of ratio analysis. Look here, is your question. Below is the answer with few working. Just we first discuss the question. Look here is the ratio analysis and preparation of balance sheet. From that ratio, your data is only this one: stock velocity or stock turnover 6, capital turnover ratio 2, fixed asset turnover 4, gross profit turnover 20%, debtors velocity 2 months, creditors velocity or turnover 73 days, gross profit was 60,000, reserve surplus 20,000, closing stock 5,000 is excess of the opening stock. So based on that data you have to prepare the balance sheet. So আমরা এটা করার উদ্দেশ্য হচ্ছে যে এর মাধ্যমে আমি ডাটাগুলির অ্যানালাইসিসও হয়ে গেল, পাশাপাশি একটা অঙ্ক সলভ হলো. So that's why we are inputting here, and also that question also comes in your one exam and previous first batch or second batch also. So here if we go for answer, this is your basic answer, balance sheet preparation. So preparing the balance sheet, first we have to calculate. Here is some ratio calculation, and that amount inputting in the year, so that balance sheet will come. So first of all, what we have to calculate? We have to calculate the sale. How would be sale? So here gross profit ratio is saying that, look here gross profit turnover is 20%, mentioning here gross profit turnover 20%. So we look here gross profit ratio. How we can calculate? Gross profit divided by sale multiplied by 100, then we'll be able to calculate gross profit ratio. So here, since gross profit ratio is 20% as turnover said in the question, and gross profit is 60, sale, what would be the sale? So within that formula, if we calculate here, look here, gross profit ratio saying 20%. So this is the 20% gross profit ratio. and gross profit, as per the question here saying gross profit is 60,000. Look here, the gross profit was 60,000. So this is the gross profit, 60,000, and divided by sale as per the question. So this is the sale. So our sale would be, if we calculate this left side, right side, then we will get total sale would be 3 lakh. So what we have find here, 3 lakh is sale. And now calculate the purchase. How much money we purchase, how much that means inventory or goods we purchase. So purchase come how cost of goods sold plus closing inventory minus opening inventory. So this way we will be able to find out the purchase. As gross profit 20%, look here, as also calculated in note 1, gross profit 20%. If gross profit 20%, then cost of goods sold must be 80%. So based on that, cost of goods sold 80%. This is the 80%. 80 divided by 100, that's the percents. And also we can calculate this way, 80%. Do not put that one. 80%. Then cost of goods sold 80% of 3 lakh. What is 3 lakh? 3 lakh is sale. So sale amount multiplied by 80%, this come 2,40,000. And this 2,40,000 will add 5,000. What is 5,000? Here saying that, look here, as per the question, closing stock was 5,000 excess of opening stock. So here formula is that plus closing stock minus opening stock. So increasing 5,000. So that 5,000 is adding here. So here saying that as closing stock is 5,000 more than the opening stock. So purchase would be 2,45,000. It's okay. Now come stock. Calculation of stock. Stock turnover ratio, as calculating stock turnover ratio as said in the question. And stock turnover ratio we can calculate cost of goods sold divided by average stock. So here stock turnover ratio or turnover here said, look here, gross, fixed, stock velocity is the turnover 6. If we put here 6 and cost of goods sold divided by average stock, then what we will get? Based on the calculation, after calculating all things, we will get the closing stock 42,500. So that closing stock amount in our balance sheet item also. So here closing stock, look here, this is the closing stock as calculating in the note 3, here 42,500. And we will take another thing, look here, now debtors. Calculate the debtors. Debtors velocity and or turnover as said in the question is 2. Here if you see the question, capital debtors, this is a 2 month. Debtors turnover is 2 month, velocity it's been turnover. So here 2 month, this 2 equal to total debtors divided by credit sale number of month. So credit sale 3 lakh, that means here look here, sale this 3 lakh, this 3 lakh is this 3 lakh, total debtors multiply by 12 month, that means here is 2 months, so here is 12 month. So total debtors is come 50,000 after calculating that. So this 50,000 is in your balance sheet item, debtors, as per the note 4. See here 50,000. And another thing here, reserve surplus is the liability that directly in our balance sheet item. No need for any note. This 20,000 is our liability. So here liability, this we are calculating in the T form. Also it is the is not using at this moment, but for the understanding we are using T form based on T, liability equal to total asset. So here, and another item we have to calculate now, calculate the creditors is also the liability. Creditors velocity as determined as a creditors velocity 73 days. So this 73 days here, or 73 or 72, it should be 72 as per the question. 72 days. Look here, creditors velocity, total creditors divided by credit purchase number of working days, because it is the 72 days. So equal to the velocity or turnover 72 equal to total creditors divided by credit purchase. So what is the credit purchase? This is the credit purchase. 2,40,000 plus 5,000. So that 2,45,000 is the credit purchase, and 360 days in the year. So definitely here we are using 360 days in our math purpose, because we know that we have also, though the year is 365 days, but is accounting purpose we are using always 360 days. So if you use 365 days, no problem, but basically we are using 360 days in per year. And total creditors divided by credit purchase number of year. So based on calculation, total creditors come 49,000. This 49,000 is the liability. It is the balance sheet liability side. As per the note 5, we are calculating 49,000. Now come capital. Capital turnover ratio, as saying in your question. Look here, what is the capital turnover ratio? This is capital turnover ratio 2. So this 2, if we put here, capital turnover ratio, you know it, equal to cost of goods sold divided by capital. So capital turnover ratio as mentioned in the question 2, if we place in here, equal to cost of goods sold, we calculated here cost of goods sold, cost of goods sold 2,40,000. That cost of goods sold 2,40,000 divided by capital, and then we can find out the capital 1,20,000. We can alternatively calculate the capital. In case of capital is taken to mean net worth, then net worth 1,20,000 or share capital plus reserve and surplus 1,20,000, and share capital plus reserve surplus 20, so 1,20,000. And from that 1,20,000, if we minus 20,000, because reserve and surplus another component, but total capital include the reserve and surplus. So here 1 lakh is the capital. We can calculate this way. So look here, that is the item 1 lakh as per the note showed 6. So capital is 1 lakh. And this is the reserve and surplus is also part of capital, because the owner of the reserve and surplus is the general shareholder or owner of the company. So it's including with there, but though a separate item, so putting here. So our liability set, okay, if you add all liability set, then here comes 1,69,000, and that should be with our asset. Now a few item need for asset calculation. So look here, fixed asset. Fixed asset turnover, as mentioned in our question, fixed asset turnover 4. If we put or place that 4 in our that question, so we know fixed asset turnover equal to cost of goods sold divided by fixed asset. So fixed asset turnover, as mentioned in our question, and multiply by fixed asset, that means is the cost of goods sold 2,40,000. So fixed asset come only 60,000. So all calculation you did, that fixed asset putting in our balance sheet asset side 60,000. So what is happening? So total liability 1,60,000, but here 3 item we get from that balance, but one item it is not mentioning in the bank and other, so that item we have to calculate is the difference between the both asset and liability. So balancing amount here putting bank balance, or you can say to cash also. So this way we can calculate that type of balance sheet. So this is one of balance sheet calculation through the ratio analysis.
Thank you.
So it's all for today. Inshallah, we will meet you in again in next week. जी, अस्सलाम वालेकुम, अल्लाह हाफ़िज़।